And welcome to another episode of the Capital Gains Tax Solutions Podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated cryptocurrency businesses, real estate, save a failed 1031 exchange, eliminate estate tax, so you can create and preserve more wealth, or help your clients, friends, and family do the same. Hey, each and every episode, we're joined by some of the best real estate, financial, and wealth advisors in the world, where they share their ideas and deal secrets so we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He is out of California. He's a repeat guest, I think now the third or maybe the fourth time. He's also in the book that we released recently, and he's known as the mad scientist of real estate. He has one of the most unique minds on investing in data analysis and systems and processes and so much more. Neal Bawa, welcome to the show. Neal, how are we doing?
Fantastic. It's great to be back on the show, and what an interesting time to be back on the show. There's so much going on.
And absolutely, let's dive right into it. You can go back and you can learn, by the way, about Neal by going to growcapitalist.com and the YouTube channel. Look up Neal Bawa, B-A-W-A. You should subscribe and listen because he's a thought leader in so many things. But today's topic, we're diving right into it, Neal, which is upcoming distress in multifamily. So maybe give 30 seconds on your background and for those who are listening for the first time, and then let's just dive right into the topic.
Sure. I'm a technologist and a data scientist. I've had a successful tech career, successful tech exit, and I got into real estate for the same reason that Brett puts you into real estate, and that is tax benefits. I live in California. I had the big fat tech salary, so I was paying 50% of my income in taxes until I realized all of the different myriad benefits of real estate and DSTs and so on. And I started publishing data science in 2009, data science on real estate, specific to real estate. And I've had a rather geeky, nerdy following of about 50,000 investors that follow us, have courses with 12,000 students taking them right now. All of it really focused around the use of data science to predict real estate profits.
Amazing, Neal. And so with that in hand, let's talk about this upcoming distress in multifamily. I mean, what is your take on what's happening? Kind of give us some of the data and some of the things that you're gleaning from this data.
Yeah, I'm going to use single family as an example, and that'll make it really, really simple to understand what's happening, right? So one day before COVID, the average mortgage for a single family home in the United States was $1,500. Today, that same mortgage for that same home is about $3,000, a little shy of $3,000. So it's almost double. The mortgage is almost doubled, right? Which is crazy because obviously incomes haven't doubled since the day before COVID. Incomes are probably up 12 or 13%. So as you can imagine, there's this huge increase, right, over time. And rents have only gone up, a little bit. They've gone up. Maybe they've gone up 15 or 20, maybe even 25% since the day before COVID, but they haven't doubled. So you see this change and you go, wow, the single family market should be crashing, right? Because like people who had a $1,500 mortgage now have a $3,000 mortgage. They clearly can't afford that. So the home prices must be coming down. They're not. Home prices in the United States basically have gone up about 1.8% in the last 12 months. And you go, that makes no sense whatsoever, right? People just simply can't afford double the mortgage. And the answer is the reason home prices in the US are not coming down, and in fact have gone up about 1.8%, is simply because of the lock-in effect. So during COVID, interest rates fell. Like, for example, I was able to refinance my home. I have a big fat home in California, and I was able to refinance it for 1.75%. A bunch of people refinanced in the 2s, some in the 3s, and some in the low 4s. And so those people can no longer leave because today a 30-year mortgage is 7.3%. So there's a nationwide lock-in effect on tens of millions of homes that have extremely low mortgage rates. And at this point, with mortgage, not just mortgage rates, but property taxes also having increased in states like Texas and Florida, people are locked in, so they're not moving. So single family home prices have remained stable. They're not going up, and they're actually projected to go down a few percent over the next year or two, but there's stability there. That isn't the case in multifamily. And the reason for that is very simple. The lock-in effect wasn't there in multifamily because in 2019, 2020, 2021, the people that were purchasing multifamily properties, the people that were buying large apartment complexes, they were buying them using floating loans, because floating loans is really the only thing that made sense for the vast majority of projects. If they wanted double-digit returns for their investors, they had to use floating loans. And because they used those floating loans, as you can imagine, those loans started at maybe 4% in mid 2021, and today many of those have gone up to 9%, and that 5% difference means that 3 to 4 thousand large properties, we're talking 200 units, 3 to 4 thousand large properties are now cash flow negative. Because at 4%, they were cash flowing. At 5, cash flowing. 6, maybe cash flowing. By 7, they were under. And now those rates are 8 or 9. And here's the catch. These properties, some of them had what is known as a rate cap. A rate cap basically is like buying insurance. You buy it from another vendor, and the vendor says, hey, if the interest rate goes up beyond this point, then everything above that we'll pay you. We'll give it to you so you don't have exposure. Well, those rate caps, Brett, those rate caps were usually 2 years long, and some of them were even 1 year long. People bought rate caps that were 1 year or 2 years, and back then the rate caps were cheap. People were buying them for $50,000, $100,000, $200,000 rate caps. Today, those rate caps are 800,000, 1 million, 1.2 million, $2 million for a rate cap, right? So now your rate, if you were capped, already you're probably bleeding a little bit, but you're about to start bleeding a huge amount because your rate cap's going to expire, which means that you now have to come up from somewhere with $1 million or $2 million for a new rate cap. And firstly, your investor is not going to give you that money because that your property hasn't been cash flowing in the last 2 years because of the increase in interest rates. The property's probably been bleeding. You've probably been doing cash calls. Your investors have had to put in more money. Well, they're not going to give you a couple $1 million for a rate cap. So now you have this scenario, and I'll stop here, this scenario where 3 to 5,000 multifamily properties are going to go back to the bank in the next 12 months. That represents an incredible buying opportunity.
Yeah, it's absolutely mathematical here, right? You're just looking at the numbers and the data, and it's 30-year fixed loans have time to weather the storm, and those that don't have the fixed loans that have adjusted, and these loans by nature, unless you did a HUD financing, which is kind of particular for multifamily, but there are those that are out there. Unless you had done that, you're expiring, and rates haven't gone down, and in fact they've only really gone up for the most part. Although it seems like they're starting to maybe soften that. Maybe we can talk about that, Neal. But the point of all this is now you have this negative arbitrage, and now your cash flow is what used to be positive arbitrage, meaning your cap rate was less than your interest rate, is now flipped. And there's only so much water you can bring into the sinking ship. Is that a fair summary, Neal?
It's a very fair summary. And there's one other difference between a single family mortgage and a multifamily mortgage. A single family mortgage, they just look at, can you pay for it, right? And if you can't pay for it, and homes are really expensive, they'll still give you a mortgage because all they care about is, do you have the income to support it, right? Now, for multifamily, as the rates go up, right, as the rates keep going up, the lenders are actually dropping the amount that they're willing to give you for the same property. It's got the same income, so its income hasn't changed. It's got the same number of renters with the same rents, so that hasn't changed. But the lenders are reducing, every time rates go up, they're reducing the amount of loans they can give you because they have this thing called debt to coverage ratio, which essentially is a fancy way of saying, if we give you $1 in a loan, we want to make sure that the property is making $1.25. Well, now as the rates go up, the property is making less than $1.25, less. That number is going down as rates are going up. And so the amount of money that lenders are willing to give you is going down, which means that it's affecting prices. So I gave you the numbers for single family real estate that the last 12 months have been 1.8% increase, and basically it's flat. Multifamily though, you are now seeing drastic reductions. And here's the cool thing. That has nothing to do with the income, the property's income, what it's pulling in from rents. Its occupancy is the same. Occupancy's dropped 0.5%, doesn't even register, right? It's a rounding error. Rents have actually gone up. So if you look at the last 12 months, rents in the US have increased, right? And they're flat right now, but they've increased over the last 12 months. So rent is going up. Your gross income is increasing in the asset, but the price that you're paying for that asset is decreasing month over month as rates have gone up. Today, we are making offers at prices that are 36 to 37% below peak. And Brett, peak was March of 2022. So, basically 19 or 20 months ago was the peak of multifamily. That's when the prices were the highest. From that peak, prices are down 36 to 37%. That's what many people are making offers on. We're making offers at 37% less. Now, that doesn't mean the entire market is down 37%, not even close, because these 3,000 buildings, they're roughly 5% of US stock. So there's 20 million apartment units in the United States, not counting all the single family rentals, right? So the multifamily rentals are 20 million, right? Of them, the units that are distressed are probably for maybe under 100,000 units, right? So less than 5% of the market is distressed. Anybody that has a fixed loan is feeling fine. Rents are going up. Things are okay. They're happy. And the majority of multifamily in the U.S. has long-term rents. So it was really only the property that was purchased in 2020, 2021, 2022 that is going to be distressed in 2024. So it's nice to see that the entire industry has no distress, but these 3,000 properties are distressed. There's going to be a lot of them that are going to come to market in the next 12 months, and people are going to buy them 37% off peak. Now, I'm not suggesting that you're getting a 37% discount, because some of those prices in 2022 were a little batshit crazy. I think you're probably getting a 20% discount, not a 37% discount, but 20% in multifamily is an astonishing discount, because you're leveraged, right? You're using 30 to 40% to buy the building. The rest of it is really a loan. So when you get a 20% discount and you're only putting down 40%, well, that gets you a long way to making an amazing return. So we're going to see incredible discounting, in possibly as high as 40% from peak, and some markets might go to 45% from peak, but it'll only last a year. And the reason it only lasts a year is because of what you said, Brett. The expectations are that we've now peaked with interest rates. Wall Street believes that completely at this point of time. You can't find any analyst in Wall Street that believes that we need to raise interest rates, but you can find hundreds of them that believe that rates will go down. Now, just one or two small declines in the rate, maybe a quarter point decrease here and a quarter point decrease there, that doesn't really solve the problem for multifamily. They need to see a lot of rate drops, which is why we think all of 2024 is basically distress slash discounting territory. By 2025, we should have enough of those rate cuts so that some of these properties that are in distress might be able to refinance. Their rate caps might get cheaper, so some of them will escape and some of them will not. And that's what's interesting about the marketplace today, that you have this amazing multifamily industry that really hasn't dropped at all in the last 10 years. Prices have really tripled in the last 10 years. And now you have this 1 year window of opportunity where you're paying as much as 37% off list.
It's really actually exciting, because for the longest time, Neal, unless we're investing with you, who are really diligent and disciplined, there's a few out there that are diligent and disciplined on their approach with investing and buying deals that make sense with the value add. We weren't buying because we were just going into multifamily debt. We were going into lending funds that were lending to those at 55% LTV so that we can have somewhat of liquidity. It's about 30-day liquid the way that we do it. And then we can get back into this moment in time with the DST, the way it all fits in. It's like it's working out to plan. Now it's time to execute with operators like yourself to find the deals. And so I think it's interesting, everything you said there. So what are the action steps that someone can take? Okay, we know there's opportunity. We know there's a window here, right? Also, at what point do you just buy it all cash, right? At what point you just like, look, let's just raise a ton of cash. Let's not do any debt or any leverage. Forget the banks. Obviously you can only go so far if you had unlimited cash, but is there a certain part where you just go, hey, forget it. Let's just not even use the debt. Let's buy it cash. And then just talk about how we can take action to find deals with you, Neal.
Anytime you can buy a property at 6 cap. So if you're somebody that understands multifamily, you probably understood what I just said. If you're buying a property at 6 cap after adjusting for your new property taxes, remember, when you buy a property, your property taxes will probably go up. So you have to adjust for that. So if your tax adjusted and interest and your insurance adjusted cap rate is in the sixes, which by the way has only happened in the last 2 months. We're only seeing deals in the sixes in the last 2 months that people are willing to accept our bids on, put us in best and final. Then it actually makes sense to do all cash, because your interest rates right now, interest rates are in the 6.25%, 6.5%. So by buying all cash, you're basically immediately, you have a cash flow of 6%. And you don't even need to leave it at all cash. You basically leave it at all cash for 2 years, two and a half years. And then when rates go down, You refinance at 4% at some point, and you don't even refinance to like a 80% loan or a 70%. Maybe you refinance 60%. And at that point, you're pulling out, maybe 60% of the cash you put in, or even more. You might be pulling out 100% of the cash, because remember, over the next 2 years, the value of your building should go up. So if you do a 60% refinance 2 years from now at a higher net operating income, because your income's gone up over the last 2 years, well, you might be able to pull out 100% of your cash. So today is the first time in the last 10 years that I've been involved in this industry that making all cash offers and only investing cash makes sense. I have not seen that at all in any other time except for today.
Yeah, I love the way you put that. And it's so simple. So it sounds like if you get a property tax and insurance adjusted, 6% true cap rate on actual numbers, right? Buy it all cash, hold for 2 years, and do a cash out refi of 50% LTV or maybe even more. And if assuming interest rates at that point are back down in the fours, to me does it get safer than that? Besides mobile home parks, multifamily, where else would you like your money to be, Neal, right now?
Not a lot of different assets. I can tell you that we are going to see vastly greater distress in other forms of commercial real estate. So multifamily is often not considered part of commercial real estate. Technically, it is. So people think of multifamily and then everything else in commercial real estate. So with the exception of mobile home parks, which I think are in that multifamily bucket, everything else is going to see a lot more distress than multifamily, and I'll explain why. So there are three extremely powerful government organizations whose only job it is to keep the single family and multifamily market liquid. No matter what they need to do, they do whatever they need to do to keep those two markets liquid. And that is Fannie Mae, Freddie Mac, and HUD. And these organizations receive hundreds of billions of dollars from the US government in liquidity and from the Federal Reserve so that they can basically make loans and make loans in a way that these markets are stable and are liquid. And but those three organizations are really mostly focused on housing, right? That's their mandate. That's the mandate that Congress has given them. So they're interested in making sure that the housing market is stable. They don't give a damn about the office market, right? They don't give a damn about the hotel market. They don't give a damn about retail market. As far as they're concerned, those markets could, bad stuff could happen and they don't care. The markets will adjust. Investors will lose money. So now you have a scenario where the office market in the United States is the most illiquid it has ever been, more illiquid than 2001 and 2008 combined. 2001, 2008 combined. Why? Because in 2008 there wasn't really a serious demand destruction that was happening in the office realm. Office demand was down maybe 5, 6, 7%. Occupancy was down 2, 3, 4%. Today, occupancy in the United States is plunging because what has happened is companies that pre-COVID were letting their employees work 1 day a week are letting them work 2 days a week. Companies that were 2 days a week are now up to 3 days a week. So there's an adjustment that has happened in the post-COVID world. Employees have gone back to work, but if you look at the total number of seats that companies need in the office, simply because they've added a day and a half to whatever they were doing pre-COVID, that means we need a lot less offices in the United States for the next 10 or 20 years. And so occupancy in markets like San Francisco is below 80%, break-even point being at 90%. In other markets, it's in the low 80s, break-even points being in the high 80% range. So the same thing that I mentioned in the multifamily industry is happening in office, but in the multifamily industry, remember I said, hey, about 5% of the market is going to be distressed. On the office side, that number is in the 30, 40, 50% of all offices in the United States that are going to be distressed. So there's going to be much longer distress that is happening on the office side, the retail side, perhaps even hotels. Hotels actually are doing fairly well because in the last 2 years, because of revenge travel, their average daily rates have gone up a fair bit, and so they're in a at least their income's gone up, so that gives them some resilience. But other asset classes are going to see problems, especially larger ones. So we are seeing on the office side and on the retail side, we're seeing large assets. We're talking about assets in the 200 million and higher range being sold for extraordinarily crazy, batshit crazy discounts. And it's going to sort of work its way down as you start moving into smaller and smaller assets. So that's where we are. I mean, there's the multifamily side is still, 1 year of distress great, get in, enjoy it, because by 2025 interest rates are down, and those three quasi government organizations are doing their job. Whereas with commercial side, I think we're going to have 2 or 3 years of distress, with office being the poster child of distress. You're going to see words like meltdown. You're going to hear words like apocalypse when it comes to office for the next 2 years. And then there's going to be knock-on effects on retail and hotel and other asset classes. Industrial, by the way, is one other place that I would put my money, because I started this segment by you asking me a question.
Yeah.
Where else other than mobile home parks and multifamily would I put money in? The answer is industrial.
Yeah.
You might see a decline in values there as well. It's not unlikely, but I think that the decline in values there is going to be cushioned by the fact that we still, every year over year, need more industrial in the United States than we are building yet. So right now, supply, supply hasn't caught up with demand for industrial. So in significant portions of the U.S., that's a strong market to be involved in.
Excellent. We're talking with Neal Bawa. You can learn more about him by going to growcapitalist.com. You can also search on YouTube, just Neal Bawa, or really any social media, and you're going to find amazing content. Neal, I want to touch on this now, right? In fact, this is a live deal. We're working with the potential seller of a mobile home park in California, and their financial advisors tell them just to pay the tax, right? This is a multi-million-dollar exit. And I presume too, he's probably learned about the DST for the first time. I don't know. I haven't talked to him yet. But the potential seller and buyer of the DST is kind of in between making decisions, right? So when if ever are you investing into the stock market, traditional stock market? Is the first question. Does Neal Bawa invest, right? Someone who has over $1 billion under management with the clients, right, for multifamily and different real estate investments. And then number two, what would you say to the person who says, yeah, Neal, just go ahead and pay that 40% tax. And as a financial advisor, I'll manage the capital, but you should just go ahead and pay that. What would you say to the person that was listening to this right now?
So I'll answer the first question. I do invest in the stock markets. I do not stay invested. So I invest in amazing companies that have lots of free cash flow and have heard very bad news on a given day, and their stock has cratered because of that. So I invested in Netflix on the day that the Russian war started, and Netflix was basically forced to pull out. They lost 2 or 3 million people in Russia, and because of that, all of a sudden, for the first time ever, their subscriber count dropped and their stock cratered. And so I bought Netflix and I sold it about 4 months later for about almost double the price, maybe 50-60% increase in price. So I had a huge increase in my money. Southwest had bad news on the day when their reservation system crashed and they canceled thousands of flights. Amazing company, great free cash flow. I make investments on the bad days, because bad days do not make a good company bad. You're just having a bad day, you get negative buzz, all of the artificial intelligence algorithms that control the stock market, they all point in the downward direction because all you're getting is bad press. And so, the price just keeps plunging and usually drops more than it should. So I've purchased many stocks in this particular way, but I'm always looking for companies that are, very, very strong on revenue and things like that. And I also like to short stock that is hyped up. So there was an electric car company that their stock shot up a while back. I can't remember what they're called, but they were a Vietnamese car company. They debuted on the U.S. stock exchange, and the stock just went completely crazy. At one point, they were worth more than GM and Ford combined. I shorted that stock, and now the stock is worth maybe a tenth of what it was when it debuted. So it came down very quickly in a matter of months. So I look at those kinds of opportunities. Basically, I'm looking for opportunities where there's value, but there's bad news, or there's overly ridiculously good news for companies that actually don't produce any profit, and that anyone should look to invest in the stock market in those scenarios. The second one is this concept of, well, let's just pay 40% tax. It almost never makes sense, but today it makes ridiculously low amount of sense given that you're being offered discounts. So maybe you don't like multifamily. Well, buy mobile homes, you're going to get a discount. Maybe you like retail, buy there, you're going to get a discount. Office, I mean, every commercial real estate asset, at the end of 2023 is offering a discount, and those discounts are likely to last for either a year for multifamily or 2 years for other assets. So when you have discounts available on the buying side, and on the selling side, you're making a huge profit. It doesn't make sense. Normally, what happens 99% of the time is this: when you're doing this, when you're making a huge amount of money on the buy, on the sell, you're losing it on the buy, because if you're making a huge amount of money here, the market's overheated. So when you buy on the other side, the market's also overheated, so you're paying too much. Well, today is a very unusual time where if you're making all this profit, clearly you're selling and you have a lot of this profit that you have to pay taxes on. You actually have a market that's discounted. That's very unusual. So I really can't think of a scenario where you would want to pay 40% tax in Taxifornia.
Yeah, I couldn't think of it either. And it's interesting to see what happens. I think sometimes it's it's balancing different ideas from different professionals, right? Who are trying to look out and find a great solution for you. We believe we have an amazing solution, especially those are exiting real estate and want to get back into real estate or into the stock market and diversify, right? And I think that can be a good thing, really good thing, especially if values are down and you have a good advisor who's finding value in opportunities that have a good companies that have bad news, like you're talking about. I love that strategy, but I just can't imagine working for 5, 10, 15, 20 years, building wealth, just to see 40% of the profits just gone forever, right? Just laying down and saying, here you go, Mr. IRS. It's tough to fathom, but people have decisions to make. And I guess there's the $33 trillion, Neal, that someone needs to pay down. I don't know, but any other thoughts on that?
It's impossible to pay that money down. There are no known scenarios in which the United States will pay down its debt. Hyperinflation or high inflation is a method that will work for a short amount of time. We can basically make some adjustments, and the 33 trillion might stop growing for a year or two if you're in high inflation. But then it has its own problems. High inflation has its own problems. So the United States, like most countries in the world, is on an unsustainable debt path, and it ends with some kind of a crash. And when that crash occurs, any kind of physical asset that is hard to create, like real estate or Bitcoin, for example, it's hard to make new Bitcoins now compared to 10 years ago. When you have these kinds of assets that have a fixed supply or somewhat fixed supply, commodities, for example, at the end of that crash, you're going to see massively higher values for these. Now, during the crash, everybody will suffer, including all of the real estate assets. So there's suffering all across the board. But if you can get through that process, you're going to see the most dramatic increase in your wealth that anyone will ever witness will occur at the point when the government makes an adjustment. And there's multiple different kinds of adjustments. I am a fan of the bail-in theory. So when the government stops being able to sell bonds, which they're having trouble with, by the way, a few weeks ago, for the first time in US history, the United States tried to sell treasury bonds. And at the end of the day, they were not able to sell all of them, right? So this is the first time it's happened in the history of this country. We are the reserve currency of the world, and still ended the day with bonds that went unsold. So that's a canary in the in the coal mine, that basically saying, hey, if the most powerful country in the world could not sell all of its treasury bonds on a particular day, what happens to other less powerful economies that are even more indebted than us, like Japan or China, that have even higher levels of debt? So I think that it's very important to understand that physical assets have value today and have cash flow. But the biggest reason anyone should be buying physical assets in the long term is you need some kind of insurance from what governments around the world are doing. We've printed about $30 trillion across the world in just the last 3 years, and that is just an absurd number. The numbers are so large that people have stopped understanding how big they're getting and how unsustainable this is.
Yeah, I could agree with you more, Neal. And this is why it's so important to be investing into, I think, real estate, but in particular, multifamily, mobile home parks, and industrial. I couldn't agree with you more on all of those points. Those are our three favorite things we're most comfortable with, what we grew up with, and what we understand, know, like, and trust, and something we can get our hands on, especially if it's value add and this component of good debt, right, and good cash flow. My screen I got this new Mac and it freezes on this thumb here. I don't know. It goes away after a couple seconds, Neal. But that being said, Neal, are you ready for the lightning round?
Absolutely. I'm ready. Let's go.
All right. Knowing what you know now, if you could go back to your 20-year-old self, what's the one thing that you'd make sure to tell yourself to do?
Buy Bitcoin, I guess.
Question number two: what's the number one book you're reading right now? Podcast, YouTube channel. Like, what's the number one that you really finding a lot of value in?
So for the moment, I'm actually finding value in a podcast. This is a daily video. It's three to 4 minutes long, and it's by Peter Zion, Zeihan. I strongly recommend it, especially because he's extraordinarily entertaining. Geopolitics is changing. So the world was very stable between 1985 and 2015. Those 30 years were the most stable years. We are now entering an age of problems. We're entering an age of a time of challenges, and the next 20 or 30 years will present extraordinary challenges, and you need to understand all of those because they impact the price of everything. So check out Peter Zion.
Excellent. Question number three: what are you most curious about right now?
I'm most curious about the impact that artificial intelligence will have on humanity. It's not about real estate. It's not about technology. AI is the single greatest technology since the invention of fire. And it is so radical and so disruptive that I'm extraordinarily curious. I'm basically paying for a bunch of AI newsletters so I can learn more, because nothing of this level of disruption has ever hit us.
Excellent. Second to last question: how are you using ChatGPT? And I promised before the show myself that I would have you, or at least ask you, to demonstrate how you speak into ChatGPT and it helps you day to day with creating content, writing, your thoughts. Can you give us an example of, Neal, how you're using GPT to do that?
Yeah, the first thing is that when you're using a paid account, and they're not very expensive. Most companies have paid accounts with ChatGPT at this point. Their revenue is going crazy, by the way. So the first thing that we've done as a company that I think most people are not doing is actually establish an identity for yourself in ChatGPT. So we have, gotten our groups together, and we brainstormed on what do we want to tell ChatGPT about us. What is our company voice? What is our messaging? Is it casual? Is it the content that we want to create? Is it what kind of content it is? So we've spent a great amount of time doing that. And once we've done that, we put that into ChatGPT. Now everything that comes out of ChatGPT is informed. So that's the first thing you really need to be doing, is creating a company identity, a company voice, and giving that information to ChatGPT. Lots of great YouTube videos on how to do that. So I'll just tell you, watch YouTube. There's people that have done a phenomenal job on it. Now, once you do that, now you have individual departments within your company that are using ChatGPT, and they need what is known as prompt engineering. A prompt is, okay, I'm doing it for a specific task, right? But for that specific task, I'm probably going to need to do some version of that task 100 times over. I need to create prompts. So firstly, my big tip is buy prompt engineering services. There's a lot of services out there for $5, $10, $20 are willing to sell you prompts, and they've got hundreds or thousands of prompts. You go in there, you select the prompts that make sense for your company, for what it is that you're asking ChatGPT to do. It just makes sense to buy them because people have refined these things over time, and the benefit that you're getting for 10, 20, $30 is just remarkable, right? So that's the next thing. So, what you do is, before you start your question to ChatGPT, you plug in that prompt, and that prompt will make the answer so much better from ChatGPT on anything. I mean, it could be anything related to diet and food, and could be related to real estate, could be any of those kinds of things. The next one is that ChatGPT has amazing capability to read from PowerPoint. So we basically are putting in entire PowerPoints into ChatGPT, and it's giving us lots and lots of summaries. It's creating speaker notes for us. It's doing all kinds of things that are making our life much easier. So I think the best way to use ChatGPT is, whenever you're doing something that you're used to doing and you've been doing it for a long time, you should be saying, how can ChatGPT make this better? And what I find is actually going into a group of 3 or 4 people and brainstorming on that and saying, how can we do this with ChatGPT, and creating new systems and processes makes a lot of sense. The final thought that I have is this: ChatGPT doesn't have a moat. I would never invest any of my money into OpenAI, the company that runs them. They don't have a moat. I'm not even sure if they're going to be around. They probably will be. They'll probably be a great company. The power of ChatGPT is not in the software. The power of ChatGPT is in starting the AI revolution. In the next 12 months, there will be a ChatGPT for X, a ChatGPT for Y, a ChatGPT for this. There will be a ChatGPT for everything, and all of those software will be much better than ChatGPT is. So the AI age has just started. We need about 12 months to have 10,000 different AI for this and AI for that options, all of them will be superior. The industry that will be affected the most, by the way, is animation. So the cost of making animation movies is going to drop by 90% within the next 2 years, because from what I can see, it's very easy for AI software to design high quality animation.
Neal, Bawa, as always, it's absolutely a pleasure to have you on the Capital Gains Tax Solutions podcast. You bring tremendous value and tremendous insight and wisdom, clarity to so much. We talked about upcoming distress in multifamily and ways to take advantage of that. Thank you for sharing on the AI. For our listeners who want to get in touch with you, what's the best place for them to find you?
I'm the only Neal Bawa on the World Wide Web. As you just have to get my first and last name right and hit enter. You'll see information about us. We publish a lot of articles on the web. There's about 25,000 people that follow our webinars, and they're all stored at Multifamily University, which is multifamilyu.com. So check those webinars out. You'll learn a lot. We don't just do them about multifamily, but anything related to real estate. We just did one on AI, and 2,000 people showed up for that one.
Amazing. Thank you so much, Neal. I also want to thank our listeners for listening to the episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets of any kind. We wrote a book. In fact, Neal's in the book, which is cool. He has a chapter. We have people like David Young in the book, people like Kevin Harrington from Shark Tank. I have a couple chapters too, and we just talk about ways to build wealth in multifamily, ways to build wealth with deferring capital gains taxes, and essentially empower you with some strategies and some thoughts from some of the best, I believe, in the world and in the country for sure, about how to build wealth in businesses. Check out Building a Capital Gains Tax Exit Plan on Amazon. And then go to capitalgainstaxsolutions.com if you want to learn more about the deferred sales trust and ways to exit your next highly appreciated